Well, those who said 2023 would be a sober year for tech probably didn't expect the kinds of returns we're seeing for industry giants like Nvidia and Meta. Did we get in over our skis, though? Or is there more upside ahead? Yahoo Finance's Jared Blikre looks at the best and worst performers. Hey, Jared.
Hey there. Well, if we take a look at the S&P 500 sectors year to date, one thing that stands out, it's really the mega cap sectors that have performed the best. And those sectors also happen to can include some of those tech and growth sectors that we talk about, the chips and the software stocks. XLK, that is tech. That's up 20.5%. On its heels, communication services, you're going to find Meta, you're going to find Verizon, Netflix, a hodgepodge of the old telecoms, as well as some what we would call tech stocks. Meta, maybe not a tech stock specifically, but we can kind of lump it in there. XLY is Amazon and also retail stocks. That's consumer discretionary. Those have been the big outperformers. What has not performed well this year is everything that performed well last year. Financials, healthcare, energy being the one huge staple. If we take a look at the one-year trailing trends, you can see energy, the only thing still in the green over that time period. And a lot of what happened this year is on the back of falling interest rates. Here's the 10-year T-note yield, what it's done year to date. Now, you can see it started off around 3.75%, had this rise in February, then during the banking panics that we saw in March, had this steep decline, and that really facilitated that growth trade. That's where the mega caps really took off and started outperforming. So the big question is this going to continue? Well, rates would have to plunge below this well-established support line. So it can happen, but it would probably take another big catalyst to do so. Also, another thing I'm watching is the U.S. dollar index, because this weekend, the Dixie weekend, and that is supported of risk factors over the month of March. For it to continue that decline, it would also have to take out some support here. And it looks like it has some pricing, some price memory just below that. So all in all, it's going to take some movement down in rates, going to take some movement down in the dollar if we're going to see this resumption of the growth trade in the second quarter here, Rochelle.
And Jared, historically, April is a favorable month for the market. So what's your take on the month ahead?
Yes, the second best month of the year, historically speaking, going back to about 1950. We were just talking to Sam Stovall over at CFRA about these stats. And here's Callie Cox over at eToro. As a market historian, I feel obligated to tell you that April has been the S&P 500's second strongest month for returns, and that is second to November. One thing I want to highlight in here, this is something that Sam brought to the forefront, is that from May to September, that is a bad stretch for the market, historically speaking. So that's what a lot of people are trying to avoid. There's the old saying, sell in May and go away. A lot of people just hedge and kind of forget about their positions or don't tightly manage them over the summer. Nevertheless, bottom line, April, historically a good month for stocks. So that is a tailwind for the days ahead here, Rochelle.
We'll certainly be keeping us busy this month then. Jared Blikre, thanks so much.